Hello, everyone. Welcome back to Investing Sucks. So today I kind of wanted to do a different style of video. A lot of the videos you see me make on this channel involve me trying to predict the future. And I usually like to talk about a certain industry that has certain industry trends or different things I see happening in the world and try and translate that into some sort of investment thesis and then present that to you guys and let you decide whether or not you agree or disagree with me. But this video is going to be a little different. Instead, I'm going to take a look into the past and I'm going to look at a company that's been tremendously successful over a very, very long period of time and try to explain how it achieved such tremendous success and also what can be learned from it, and talk about why success stories like this one truly solidify the value investing philosophy as, in my opinion, the premier investing strategy there is. So the company that I'm going to talk about is Home Depot. We can see their returns compared to the S&P 500 on the screen here. And if we look back to when they IPO'd initially, which was in early 1982, they were about 3 cents per share. Now, they weren't actually that low. It's just because a lot of stock splits have happened along the way. But we compared their returns to the S&P 500 over the past 40 years. The S&P 500's done 3,768% return, and Home Depot has done 1,159,700% return. So not a bad return. And if we take a look at their financial statements in the more recent years, we can see currently they're doing close to $150 billion in annual sales, and they're currently the second largest retailer by market cap, only behind Walmart. And what's interesting that I found was when we look at their gross margins and we extend it back, say, way more years so we get more complete data, go back to 2009, we can see their gross margins have been remarkably consistent, pretty much in the 33, 34% range, really not changing. That's probably just their company policy. They look for that much markup on all the products they sell. And if we take a look at their operating margins, we can see in 2009, they had about 7% operating margin, and this has been gradually increasing over the years. So we can see 9% 2012, 10% the next year, then 11, 12, 13, 14. And then as it stands today, it's at about 15.5% operating margin. So it's pretty much doubled in just over a decade. So that's a pretty significant increase. So how did they do this? What's so unique about Home Depot that led them to become this wildly successful company? And what did they do that was so much better than all the other competition that led them to be so successful for close to 40 years? Now, Home Depot was founded in the 1970s, and they really revolutionized the home improvement industry. They were founded with the idea that customers wanted a one-stop shop for everything home improvement. They wanted really big stores that would have everything that they would need, and they could just go to one location and just pick up everything they wanted. That was the initial strategy. But when the company has delivered over 1,000,000% return over 40 years, you know they've been constantly innovating throughout the years and changing their business model along the way. So what I want to do is take a deeper dive into the financial statements and see if we can find any evidence of that type of innovation. So let's start by just looking at the top line revenue growth. And I'm going to extend this back even more years so we can get an even more full picture of what happened. So we're looking at these metrics here, and we can see the revenue grew for these 2 years, but then it actually declined in 2008, 2009, and 2010. So you can probably guess why that is. Those were the years of the 2008 housing crisis. So it makes sense that a home improvement retailing company would probably not grow their revenue in those years because there's probably just not as many houses being built and just not enough demand for them. But then if we look past that, we can see their revenue growth has actually been speeding up over the years. We can see it was only 2%, 3%, and then in more recent years, and especially year over year, it went up quite a lot. And we all know why that is. There was a huge boost in demand for home improvement projects. So Home Depot is obviously a huge beneficiary of that. Now, what we can also do is look at the trend in the price to sales ratio. So I'm going to go to valuation here. And then what this tells us is how optimistic are investors about the future of this company. So how much are they willing to pay for every dollar of sales that Home Depot generates? And clearly, if we extend this out, we can say they've becoming increasingly optimistic throughout the years. So if we go back to the years of the 2008 housing crisis, they were trading at below half of their sales, which seems extremely low compared to where they are today, which is they were close to 3 times sales, now more at 2.6, 2.5 times sales. So if they were to revert down to their low, that would be a huge decline in the stock price. Now, it's unlikely that that will happen. And you also have to consider that their operating margins have been improved quite a lot now compared to where they were in 2007 to 2009. As we saw here, we could see operating margins. So these actually went down quite a lot in the years of the financial crisis. So 9, 7%, and then they've become increasingly better. Now, what we can also infer from these operating margins getting better is they've probably innovated their supply chain quite a lot. And that's probably where these amazing returns of the stock have come from. Because if you think about Home Depot's business model, it's really nothing that complex, right? It's just a big home improvement store. So how do they get an advantage? Well, they have to offer their products at the best possible price and still be able to make enough money off of it. So they need to manage their supply chain very effectively. So then what I decided to do was take a look at their annual reports from the 2007 to 2010 years and see if there was any mention of some new supply chain strategy that they were implementing, which would lead us to believe why these operating margin increases took place and were so drastic. So when I went to their 2007 annual report, that's what you're looking at here, I did see that there was mention of this. And they describe it here. They say they're transforming their supply chain. We piloted a new distribution network and technology, which they're calling rapid deployment centers. So what this was really was a shift between having their vendors ship their products directly to their stores, their big giant stores, and instead have these more centralized distribution center where they'd have these rapid deployment centers where vendors would ship products to there, and then from there they would disperse the products to whatever store they needed to go. And what this led to was lower transportation costs for one. And also, as we can see here, it led to simplified order processing with their suppliers and a reduced lead time from store product need determination to replenishment. So essentially what they're saying there is once they determined that a store needed a replenishment of a certain product, there's a smaller lead time between actually, deciding that they need it and getting the product into their store. So based on that, what I would also expect to see over the years would be an improved inventory turnover, right? And that's a very important metric to understand with retail companies, because retail companies, obviously, they sell physical goods. Inventory is a huge part of their balance sheet, and inventory does require cost, right? If you have a large inventory, that requires cost in order to maintain. So ideally, you want to have a lean and small inventory, but not so small that you're having product shortages and you're missing out on sales because you can't meet the demand that's there. So if we go to valuation, we can actually take a look at what these metrics were. So inventory turnover, this represents the number of times that a company sells their entire inventory. So if inventory turnover is higher, that means they're selling their inventory faster. And then another metric we can look at is days outstanding inventory. So this is on average, how many days does the company have an item in their inventory before it eventually gets sold? So we can see here that their days outstanding inventory was 78 days in 2006, and then it then went up to under 89 days in the 2008 financial crisis. And then it's kind of been on a slow downward trend. We can see it's been in the high 70s and then the low 70s, and then fast forward to today. And in the most recent year, it was under 65, which means in the past year, they've been selling their inventory at a faster rate than they've been selling their inventory pretty much at any point in the last 15 years. That's what this data tells us. And then if we go one row below, we can look at days payable outstanding, which has been pretty stagnant. There's no real discernible trend here. And what this measures is the average amount of days it takes them to pay their suppliers for their inventory. Now, I want to compare that to Walmart, because this is going to reveal a pretty interesting trend, in my opinion. So if we look at Walmart and we extend it back all the way back to 2005, so we could see what the trend has been over a period of about 15 years. So let's look at their days outstanding inventory. So it was 47 days in 2005, and then it's kind of hasn't really changed a whole lot. It's gone down a bit, but what has changed a lot is their days payable outstanding. You can see it's been 34 days here, and it's now gone up to, in the most recent year, 46 days. So that's a pretty significant increase. And that signifies market power for Walmart, because the longer you can extend the amount of time it takes you to pay back your suppliers, the more you can free up that cash to use it for different things. And if we look at their cash conversion cycle, which combines all of these things, we can see their cash conversion cycle is getting pretty close to being negative. which means they're actually sending in orders to their vendors for their goods. They're receiving those goods, they're selling the goods to their customers, and then collecting payment from their customers before they actually have to pay back their suppliers, or only about a day and a half before they have to pay back their suppliers. So that means they have a ton of cash that gets freed up that they can use for other things. So that's just really good working capital management. So here we can take a look at what the effect of this supply chain modernization has been that they implemented in 2007 over the years. And we can see here in about 2007, they were around $40 per share. And today they're at $340 per share. So almost a 10x increase over the past about 13 years. So that just goes to show that sometimes in order to get an amazing return on a company, over the long term, it just takes them shifting their strategy in one way or doing one thing that's different or unique, and you can get returns like this one. Now, the success of Home Depot also provides many critical investing lessons that I want to share with you. And specifically, it can teach us why the value investing philosophy is, in my opinion at least, the premier investing strategy for building long-term wealth. So what value investing is at its heart is figuring out how much a business is worth and then buying it for less than that. That's really all it is. Now, personally, I find that there is a commonly held belief amongst novice investors or beginner investors where they seem to think that the only way to get wealthy by investing in stocks is to invest in the booming next big thing type of industries, whether it's electric vehicles, gene editing, quantum computing, artificial intelligence, the metaverse, whatever industry you want to talk about that's, making all the headlines and is in the news. People seem to think that you have to invest in those industries. Those are the millionaire maker industries. And it makes sense why people would think that a lot of these investing articles or investing media outlets tend to pump that type of narrative and really can convince the beginner investors of that. And also, let's say you're someone who you want to get rich faster, right? You don't want to wait until you've been working for 25 years and buying index funds to become a millionaire. You want to be a millionaire faster, and you want to use investing as a way to, achieve that goal. So you're probably going to be looking to these types of industries that are being touted as the next big thing because you're being told by the media that this is how you should be investing your money. These companies are going to be massively successful in the future. But the issue is that these industries tend to have the most richly valued companies, not to mention these companies are often running massive losses. They have unproven management teams. The management teams have a very limited track record, so you can't really evaluate their past successes and failures. And of course, because they're new industries, they still face a ton of uncertainty. So there's a lot more risk, right? There's obviously also more potential for reward, but there is a lot more risk. And what you have to understand is that companies whose valuations are propped up on a commonly held belief among investors that they're going to be wildly successful in the future, rather than the more value-oriented stocks like Home Depot, for example, whose valuations are dependent on how much money they're making in their current phase, there's a lot more downside for the higher risk investments out there. And we're seeing this happen in real time right now. We're seeing it happen with Shopify. Their valuation has gotten cut a lot. Palantir in the US market is another company that sold off a lot today. Once the growth story starts to slow down, people realize that the future for these companies maybe isn't as optimistic as they thought it was. And then the valuation comes crashing down. Now, when you're talking about risk and reward, the reason people would be investing in these higher risk companies is because they perceive there to be higher reward. But I'm trying to make the argument here that companies like Home Depot prove that you can obtain very fantastic returns, right? 10x, 100x, or as we saw with Home Depot, 1,000,000% return over the course of 40 years. And you don't need to invest in these high risk industries. You can do it by buying these value stocks, right? There's plenty of small cap, overlooked, less followed value stocks out there. They've been profitable for many years. They have proven management teams that know how to allocate capital and how to expand the business sustainably. And they're only trading at, say, 10, 15, 20 times earnings or free cash flow. And identifying companies that have superior business models and management teams to produce these 10x, 20x, 100x returns over several decades, right? Not just overnight, because that's probably a sign you're in a bubble. In my opinion, doing that is no less difficult than identifying which companies out of the many that are in this brand new, sexy, up and coming industry are going to be the winners, right? Because not all the companies will be the winners. There will be some that do well. For example, Amazon was a company that did well in the 2000 dot-com boom, but most of those dot-com stocks pretty much did nothing, right? If you look a list at dot-com stocks from 1999, you're probably only going to recognize a couple of them because most of them aren't around today. And the other thing that you have to consider is that the companies that are in the brand new sexy industry, when they have their IPOs, they're IPOing at extremely, extremely elevated valuations. Now, an example of this that's probably going to happen later this year, which I have an article in here, is a company called Databricks. So this is a company that they're probably going to IPO later this year. They were last valued in the private markets at $38 billion. They're probably going to IPO for, I would assume, at least twice that. And who knows what they would shoot up to on their first day of trading on the public markets. But let's say conservatively they IPO at $50 billion. Now, if you wanted to invest in this company, which by the way, Databricks, they're pretty similar to Snowflake. If you guys have heard of Snowflake, they're kind of like a data cloud type of company. In order for you to earn a 10x return investing in Databricks, if they IPO at $50 billion, they need to become a $500 billion company, literally one of the most successful companies in the entire world. And they need to not dilute your ownership percentage in the company by issuing more shares, which most of these companies do because they issue stock to their employees as a way of retaining them. And they have to issue shares in order to fund their losses because they're probably running massive losses while they scale up the business. So all that needs to happen in order for you to earn a 10x return. And really with a lot of these hot IPOs, to be honest, the high returns in these companies have probably already been made by the time they've gone public. They've been made by the Silicon Valley venture funds that invested in them early, or the celebrities that had access to these private funding rounds, all before the average retail investors could get access to their shares once they finally went public. And they know that these retail investors will invest their money in whatever is being touted as the next big thing, right? It was like this 100 years ago when you're talking about railroad stocks. Those had a massive speculative boom. It was like this in the year 2000 with the internet stocks. And it's like this right now, in my opinion, at least, with clean energy and electric vehicles. And of course, whatever tomorrow's next big industry is going to be. Now, compare all of that with Home Depot. Home Depot went public in 1984 at a valuation somewhere in the range of $2 to $3 billion. I couldn't find exactly what it was, so I had to do some rough calculations. So let's say they IPO'd at $3 billion. You don't need Home Depot to become one of the most successful companies of all time in order for you to earn a very high return on them. And again, doing that just really comes down to your ability to identify a company that has competent leadership. They have a sustainable, durable competitive advantage. They have great capital allocation strategies, and they know how to innovate in the business. As we saw with Home Depot, they innovated their supply chain, and still to this day in 2020, they're continuing to innovate, showing that they are always geared towards the future. Now, doing that is obviously difficult, right? There's no secret formula, and if it could just be determined how to do that by using computer algorithms, then it would be impossible to make any money doing that because all the potential returns would just be priced away. But this does kind of serve as a lesson that you do not need to invest in these overhyped industries if you want to earn great returns. You can do it by investing in these value stocks. It's still difficult, but it is definitely possible. So anyways, guys, that pretty much does it for me for this video. So thank you so much for sticking around and listening to my thoughts. I really hope you did enjoy it. If you did, then please leave a like and subscribe if you're new to the channel and you enjoy this type of content. And I'll see you in the next video.